Hello, this is Judith Paquette, and this video is about accounting system transactions. We will be talking in more depth about what is and is not an accounting transaction. The definition of accounting is identifying, collecting, and analyzing information, processing transactions, and then communicating the financial results to management to help with decision making. You've already seen the communications side because you've created the income statement, statement of retained earnings, and the balance sheet. And that's the financial results that accountants create. They also provide a written analysis to help management make decisions. This is a very detailed flowchart here, and we're going to focus on these first two boxes: identify, analyze business transactions, and collect the appropriate documentation, and then record the business transactions. In the next videos and in the next chapters in your book, we'll be going through some of the rest of these, creating actual journal entries, posting journal entries, creating a trial balance, making some adjustments, and creating the final trial balance. And the financial statements, which again you've already had a taste of in an earlier video, and then closing journal entries, creating a post-closing trial balance, and then the next month or the next year starting all over again. What is an accounting transaction? And you will spend a good part of Accounting 201 asking yourself, asking each other, is this a transaction or not? Some of them are very obvious, some of them are more subtle. But the definition of an accounting transaction is an economic event that requires recording in the financial statements. There can be events that don't lead to a transaction, so we need to look at each one individually. What has to happen with a transaction? There's a dual effect on the accounting equation. An asset, liability, or stockholders' equity item must change. And remember the accounting equation: assets equals liabilities plus stockholders' equity. Let's practice. Should the following three events at Outdoors Corporation be recorded as accounting transactions? Remember, Outdoors provides guided hiking and rafting trips. Transaction 1. Outdoors Corporation purchases a 12-passenger van. Did Outdoors have an economic event? Was an asset, liability, stockholders' equity, revenue, or expense account affected? Was there an exchange? Answer: yes, this is an accounting transaction. Outdoors got the van, increasing an asset, equipment. Outdoors paid for it, decreasing an asset, cash. Or it agreed to pay at a future date, which would create a liability, accounts payable. Next transaction. Outdoors discussed an upcoming rafting trip with a potential customer. Did Outdoors have an economic event? Was there an exchange? Let's see. No, this is not an accounting transaction. There has not been an exchange. This is a really important event, talking to potential customers, but there just hasn't been the exchange yet, so therefore we can't record an accounting transaction. Let's do another one. Outdoors pays its gas bill. Was there an exchange? Was there an economic event? Yes, this is an accounting transaction. Outdoors got gasoline, increasing an expense, gasoline expense, and Outdoors paid for it, decreasing an asset, cash. We're going to get into more analysis of transactions, but let's review the basic accounting equation. Assets equals liabilities plus stockholders' equity. I like the expanded accounting equation better than the basic accounting equation because it has more major account categories in it. So let's look. Assets is the same on the left, liabilities is the same on the right, but under stockholders' equity I've listed 5 more categories. Common stock is an account, retained earnings is an account, and then revenues, expense, and dividends. Now, why are they listed under stockholders' equity, these last 3 items? Remember, revenue minus expenses equals net income, and that gets included in the final calculation of retained earnings, as does dividends. It is also included in the final calculation of retained earnings. This will make more sense in our next video, the worksheet, where we do the books for Legal Writing for You, a startup company.